my name is Jason Libinson. I'm head of sales and marketing for Galileo Equity Advisors here in Toronto. I'm with Sam Pelaez today, Chief Investment Officer and Portfolio Manager at Galileo. So Sam, I think we should start by talking about our GOGO ETF, better known as GOGO on the TSX. Maybe you could speak to our smart beta approach when investing in the minings market with GOGO.
Yeah, so the model we've used to create GOGO was a long time coming. We worked a lot with what we call quantamentals, which means quantitative assessment of quantitative work and research on the fundamental of companies. Financial statements, growth metrics, growth factors, valuations, a bunch of other key indicators that we look at. So we've been learning, there's been a learning curve that's been going on for years at US Global. That's when we first started working with these quantamentals, and I brought that to Galileo with me when I moved up here. The GOGO construction is the result of that process. We've been very successful with that, and now we're rolling that into all of our funds to benefit from the investment process.
I think it's also important to note that since inception, GOGO on the TSX has been the best performing gold ETF in Canada. What do you attribute to it being the best mining ETF since inception?
And it's exactly what you mentioned, is the smart beta construction that came from the quantamentals. So we look at a number of key factors. Valuations, we look at operating cash flows per enterprise value. That gives us a valuation metric that we prefer over PEs and all the other valuation metrics that are out there. We do prefer the OCF to EV. We look at revenue per share growth. We've known that metric, especially in the gold space, has been a very powerful one over decades. That's what our research shows. And we also look at return on invested capital. Return on invested capital is an assessment of the management team of a company. How good are they at allocating capital? If they're good allocators of capital, the return on capital will be superior. The return on invested capital will be superior to that of their peers. And when you put those three factors together with a few others that we also accommodate, you have a winning formula, and that's what's been demonstrated. That's been demonstrated since inception.
So you've walked through what type of companies you're looking for and what type of metrics you're looking for. But can you speak to some of the actual companies themselves that meet those metrics that are currently in the portfolio?
Yeah, so for GOGO we have 4 buckets. The first bucket is the royalty companies. We believe the royalty companies have a superior business model. Their revenue per share growth is substantially higher than anybody else in the space, at least when you look at 10-year track numbers. So they have the top position in our ETF. The next bucket is for producers. That's 4% allocations across the board, and that's when we add return on invested capital, and we add the valuation metrics. And that's how we select companies that are superior to their peers. When you think about the investment process that we utilize, we backtest these factors, which in this case are the 3 factors I mentioned. We identify them, and then we create a safe harbor of stocks. These are the stocks that have higher probability to succeed or to outperform relative to the market. Once we've selected those companies from the safe harbor, we have a number of trading algorithms and disciplines that we implement to be able to catch big movements in markets, PMIs, 50-day moving averages, 5 and 20s, MACDs, and a slew of others.